The UK's newly appointed Chancellor, Rachel Reeves, is under a lot of pressure. To keep the Labour Party's pledge of managing national debt, she's weighing up the benefits of reducing public spending or increasing certain taxes. The party has already committed to leave income tax, VAT and corporation tax rates as they are, so where from here? As the Labour Party has only recently won its landslide victory earlier this month, it's difficult to say what their economic policies are for the future. However, many have pointed to the similarities between their plans and the IMF's recommendations under Article 4. Article 4 is simply a set of recommendations given by the IMF following an assessment of the UK's economy. The article provides an outside perspective on how the UK might benefit from tweaking its existing tax regimes. Their previous recommendations included broadening the base of VAT. They've also suggested the capital gains and property tax regimes be reformed, so watch this space. The one recommendation that has raised many eyebrows is their suggestion to reform inheritance tax. More specifically, they believe an inheritance tax on pensions would do wonders for the national coffers. Under the current regime, any assets held within pensions are free of inheritance tax. Pensions are therefore free of IHT when passed to a beneficiary as part of the deceased's estate. They may not be free of income tax, but more on that later. Economists have pointed to the way in which this exemption pushes retirees to spend assets that are liable to IHT, accumulating as much as possible within pensions to escape IHT when passed down. The view is that as pensions have been engineered in a way to support retirees, they are instead being used as a vehicle to mitigate IHT, leaving the taxman empty-handed. To combat this, a proposal under consideration is bringing pensions into the IHT crosshairs. Labour are aware that an inheritance tax on entire pensions would be deeply unpopular. They are therefore looking at levying IHT on cash held within defined contribution pensions. Economists believe that taxing cash within pensions on death would raise $1 billion to $2 billion over the next 10 years. A healthy chunk of change, but a drop in the ocean compared to the country's outstanding debt. Ignoring the practicalities of taxing cash balances within pensions at a plan holder's death, this raises a number of concerns for retirees who rely on income from their pensions during retirement. Pensions should be viewed as wrappers within which investors can hold a combination of assets, such as cash, bonds, funds, shares, property, or even vintage cars. Over the course of your working life, assets within this wrapper continue to grow free of tax. Investors with a longer term to retirement are advised to undertake more risk within their pensions for potentially higher growth before their eventual retirement. As they approach their ideal retirement age, it's often recommended that these assets are moved into less riskier assets, avoiding volatility before taking cash from the pot. There are arrangements such as lifestyle strategies that de-risk assets automatically ahead of a selected retirement age. If an investor intends to draw an income from their pension in retirement and they remain in high-risk assets, they may risk taking funds during a market downturn, significantly reducing the longevity of their pension. One way in which retirees avoid this is to hold a large chunk of the pension in cash, say a year's worth of retirement income, allowing the invested element to grow independently. They can then draw an income in retirement from the cash portion of the pension, safe in the knowledge that this won't fluctuate in value. When the time is right, and their investments have grown sufficiently, they can sell a portion of their investment holdings to top up their cash balance. Under these new proposals, should a retiree pass away, however much cash is held within the pension will be liable to inheritance tax of 40%. For fortunate retirees with sufficient assets outside of their pension that can be used to finance their retirement, this proposal won't pose much of a problem. They'll simply ensure their pension is fully invested, allowing the pension to pass to their beneficiaries free from IHT as normal. However, many of us will be relying on our pensions, and so this tax could be significant. One potential way retirees could escape this tax whilst continuing to draw an income from their pensions, is by investing in cash-like assets, such as money market funds, that would normally form the cash element of their pension. We don't yet know what would be considered as cash under this proposal, or if it'll come to pass at all. Many tax specialists have outlined the potential for double taxation of pension funds under the proposal. Under the current regime, if a pension holder dies before age 75, the pension not only passes to a beneficiary free of inheritance tax, but the beneficiary is also able to draw an income from this pension free from income tax. Over age 75, beneficiaries will pay income tax on drawings from the inherited pension of 20, 40, or 45%, depending on their income. If this proposal is brought into play, beneficiaries receiving these pensions will not only pay income tax on drawings, but also up to 40% IHT on cash within the pension. In a worst-case scenario, beneficiaries could pay a maximum of 85% tax on cash within a pension, 40% inheritance tax, and 45% income tax for additional rate taxpayers. Let's work through an assumed example together should pension cash become the subject of IHT. Sean is a pensioner relying on his personal defined contribution pension to provide his income in retirement. He retires at age 65 with $300,000 in his pension. Sean is a cautious investor and is not comfortable taking risk within his pension. He therefore holds 50% in a low-risk bond portfolio and 50% in cash. Over the course of his retirement, he draws an income from the cash element of the pension and switches his bond holdings to cash when the portfolio has performed well. Sean passes away at age 76. Through careful management, he leaves a sum of $150,000 in his pension to his daughter, Lisa. £100,000 of this amount is held in cash and therefore becomes subject to IHT. Sean's estate has made full use of his nil rate band. The full cash balance will therefore be liable to 40% IHT, or £40,000. Lisa is a higher rate taxpayer who elects to draw an income of £500 per month from the inherited pension, or £6,000 for the year. As Sean dies after age 75, Lisa will need to pay higher rate tax on these drawings of 40%. On this £6,000, which she takes from the cash portion of the pension, not only has 40% IHT been paid, but 40% income tax too, 80% overall. We don't yet know whether a tax on cash within defined contribution pensions will happen, so this is purely speculative. This example is drawn together using current rules, but a lot can change, especially under a new government. If you'd like to know more about how pensions work, or if there are any areas of finance you'd like explained in further videos, don't hesitate to leave us a comment or get in touch with us directly. We're happy to help on an individual basis. If you'd like to explore the potential impact of the pension cash tax in more detail, the Xenia learning page provides further reading, along with a transcript of this video for future reference. Don't forget to like and subscribe for more tips for tax savings, investment strategies, and financial planning. Remember that if you're looking to draw an income from your pension, it's always wise to consult a professional before doing so. There are various rules, exemptions, and strategies that should be considered to ensure your pension lasts for the duration of your retirement. Until next time, plan smart and prosper.